Your neighborhood's property value isn't an accident. It's the result of a deliberate government policy that ended decades ago but never actually stopped. Most people think segregated neighborhoods happen naturally. White flight, personal preference, market forces, that's the story we tell, but that's not what happened. Between the 1930s and 1960s, the federal government literally drew red lines on maps. Those lines marked black neighborhoods as financial risks. Banks wouldn't lend there. Insurance companies wouldn't cover homes there. The government itself wouldn't back mortgages there. Here's the mechanism. A homeowner in a redlined neighborhood couldn't get a mortgage, so they couldn't build equity. Meanwhile, their counterpart 3 blocks over in a non-redlined area got a government-backed loan at 3%. That person's house doubled in value. Their kids inherited wealth. That wealth paid for college, down payments, emergencies. The redlined homeowner's house stayed flat or declined. Their kids inherited debt. You might think that was 60 years ago. Surely it's fixed by now. It's not. Redlined neighborhoods from the 1930s still have lower property values today. A 2023 study found homes in formerly redlined areas sell for roughly 23% less than comparable homes in non-redlined areas. Same square footage, same condition, same neighborhood amenities. The only difference is what a government pen did to a map. Why? Because property value is about one thing: lending. If banks won't lend, property doesn't appreciate. If property doesn't appreciate, homeowners can't refinance at better rates. They can't access home equity loans for repairs. The house deteriorates. The neighborhood deteriorates. New investment doesn't flow in. And crucially, the racial composition of those neighborhoods stayed concentrated, which gave lenders an excuse to keep not lending. The policy created the condition it claimed to describe. The median white family's net worth is roughly 10 times the median black family's net worth. That gap didn't appear from nowhere. It's the arithmetic of redlining compounded across 3 generations. Grandparents couldn't buy, parents bought less, kids started further back. Today, even when people have identical incomes and credit scores, lending discrimination persists, sometimes called modern redlining. Some cities are now trying to reverse it. Targeted investment programs, community land trusts, down payment assistance in formerly redlined areas. But policy moves slowly and compounding works both ways. Wealth builds on itself, so does disinvestment. Understanding this isn't about blame, it's about seeing why some neighborhoods cost what they cost and why that cost has almost nothing to do with the neighborhood itself. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe so you don't miss the next deep dive into the economic forces reshaping where we live and what we pay. Subscribe so you don't miss the next deep dive into the economic forces reshaping where we live and what we pay. This video is for educational and informational purposes only and is not financial advice. Always do your own research.